In this week's update, the weight of money is making a huge statement. And what's the signal for commodities to move much higher? My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Middle East, we've got a rip-roaring stalemate, and it's pretty hard at this stage to see how things are going to change. So markets have moved on. The pricing of a disastrous outcome is no longer there. Markets don't seem to be terribly worried about the outcomes in the US. Is that fair enough? Or is that taking too bullish a stance? So the question is, can US equities possibly be performing that well to justify the chart that you'll see in just a minute? And the answer is, if you are researching a lot of US companies, as I am, that the earnings growth supports the prices. When you look at the percentage year-on-year earnings growth from, let's say, 2 or 3 years ago to the next 3 years forecasts, and you look at the current PE, then I have no problem with the valuations for many stocks. Not all, some are way ahead of where they should be. But for many, many stocks, and I'm talking potentially hundreds in America, the earnings growth and the outlook support the current prices. And that might come as a surprise to many, but it's the situation. So I think about risk in two ways. The first part is to position yourself for the risks that are facing us at the moment. And not only are they potentially severe, but they're also incredibly unpredictable and unknown. So in my view, you need to position to cover the disastrous outcomes. Now, that doesn't mean that you take actions that assume a disastrous outcome. You just need to make sure that you've got them somewhat covered. But I'll have more to say on that later in the video. And in doing so, raise some strategic cash levels to be used for the really good opportunities that come around when the market panics. And we had a panic during March of sorts, and strategic cash came in very handy during that period. So that's the first thing. Position yourself at a big picture level to cover the really disastrous outcomes. And then the second thing, and the most important thing, is to use charts as an indicator of where the money flow is, so technical risk management, and we observe and we respond to a set of predetermined and very succinct exit rules. And they've got to be simple, because if there's any degree of shades of grey or complexity, then when you need to sell, you're generally under some sort of emotional pressure. So if you've got a complex set of rules that maybe it's triggered, maybe it hasn't, then you're not going to know what to do. So they need to be very clear, very succinct. And that is the way that you deal with this kind of market. First of all, position yourself appropriately, and then make sure that you're observing what the market is telling you and responding to it. As we say every week, this market is about as tricky as you would find. However, that sort of environment will create wonderful opportunities, because the market will overreact and outstanding companies will be available at prices that you never normally see. So it's a double-edged sword. One goes with the other. Let's look at American stocks now. The S&P was up 0.5% for the week, and the NASDAQ put up 1.5%, which is a pretty extraordinary performance. And when you get to the charts, you'll see what I mean. The Russell, a little bit more somber, only up 0.3%, but at least it was up for the week. And as I said last week, a bit tongue-in-cheek, but this was for me, another John McEnroe week for the NASDAQ, and I'll show you what I mean by that. So that's a weekly chart of the NASDAQ, and if you just look at the bounce over the last 4 weeks. So if you were doing what most people do and what our underlying psychology would have us do, and that is look at the price chart, think about the fundamentals, and your reaction has to be, you've got to be joking. That just cannot happen, because it doesn't fit with the current market circumstances or the current global circumstances. But when you've been in the market long enough and you've seen the way that prices move way ahead of the fundamentals, not only the prices, so there could be two things happening here. Either everyone has completely lost their sense of value, or the market has basically said very clearly that the money flows are supporting higher future prices. And when you get a move of this strength, then that is a huge amount of money commitment, and it's being made by professionals. So you've got to take notice and not dismiss that as just wild speculation. There is a massive amount of money that is underlying the last 4 weeks' move in the NASDAQ. So that was yet another seemingly you've got to be joking kind of week in America. But when you really do start researching and looking at the underlying fundamentals and the outlook, and particularly the immunity to these really nasty things that could happen, then it makes a heck of a lot more sense. So that was the US indices for the week. I'll go back to that in a minute. The dollar, 98.5, and this is really critical, particularly for commodities. The 10-year yield was lower at 4.31, and the VIX is just kind of fluctuating up and down between around 17 and 19. So not a lot of change there. So let's look a little more broadly at the US market. So that's on a weekly chart, and that really does make a dramatic statement, because not only is it 4 weeks in a row, but it's 4 weeks in a row that have more than wiped out the previous 10 or 12 weeks. So this has been a massive movement of money. This is the NASDAQ versus the S&P, so that's clearly the money is flowing preferentially into growth stocks, which is more reflective of the NASDAQ. This is consumer discretionary versus staples, and it's just continued what we saw last week. But this is a really big one. This is semiconductors. And you've heard me say week after week for years and years and years, if the semiconductor sector is doing well, then the rest of the US market is generally going to be doing reasonably well. I've never seen semiconductors go like this and the US market going the other way. So that is an incredibly powerful statement, and that's supporting what's happening in the NASDAQ. So if we look at the comparisons on a sector basis, energy is still up there, and the energy story is certainly by no means run its race, as we've been reminded in the last week. XLK, so technology, the overall sector has moved up very, very strongly, and it was only a few weeks ago we were right down the bottom. Technology, thanks to software, weakness in software, was pretty much at the bottom of the totem pole, and now we've just rocketed back up. Then we've got industrials, followed by materials, and then the S&P itself, and everything below that. So we've got staples, which is defensive, we've got communication services, we've got banks, we've got consumer discretionary, and then we've got healthcare at the bottom, as indeed it is in the Australian market. So that's how we set up on a sector basis in the US over the last quarter. In Australia, a few differences. Energy, obviously, at the top of the tree, but finance. But you'd have to think the way the Australian economy is being positioned or being on the back foot, that banks are in the firing line for a significant amount of provisions that are going to have to be made, and that's going to depress their earnings outlook, and that's going to depress the multiples that the market is prepared to pay for them. And that double banger effect of a reduction in earnings forecasts and a reduction in the PE ratio the market is prepared to pay could have a significant negative effect on bank shares. So that's where we sit in terms of those sectors. The S&P looks quite similar to the NASDAQ. It's just not quite as amplified as the NASDAQ is. The energy sector, 3 weeks down when people were expecting a ceasefire, but last week it was back to reality again. And this is the Russell 2000. Now, importantly, currencies. So this is really important for the commodity space. This is DXY, the US dollar index, and we're in a big picture downtrend. I'll just take that out of there. So we're in a big picture downtrend, which peaked in September of 2022. We then consolidated for a lengthy period of time. We then dropped sharply through this important support zone. We've been consolidating again. We do have a falling resistance line. And the key for me is around this 96 area. So we've broken below 96 on one occasion and then rallied back up. But now we've had rejection again. This is a pretty meaningful resistance line through here that was rejected off on Friday. So for me, the key for markets and for commodities is around this 96 level. If we break below that, then that'll be not only a very significant positive for commodities, but I think it'll also be making a pretty big statement that people will take notice of with respect to commodities. So the big picture trends still favour a really, really strong multi-year commodity move ahead of us. It's just when and how much is what we don't know at this point in time. The Australian dollar is going the opposite direction, and we're up into the 71s now. So it's really just following along with the US dollar. So Aussie Stocks, 71.45 is where we finished. Our index was down 1.8% for the week. I really don't have any feel for how the index is going to go in the early part of next week, because the lead from America is obviously very strong, but we've got some homegrown truths here that I think are going to play out with continued selling pressure. I hope for the good of the country that the issues that are being resolved at the moment, but only resolved on a short-term basis, the actual underlying issues are actually addressed. I'm a little pessimistic about that because I read things like this, which was a comment made by one of our government ministers: building a new oil refinery is not realistic. I mean, I have to shake my head and wonder at how anyone could make that statement. I mean, we're talking about the very basis of our quality of life being put under very realistic pressure and being in significant doubt in terms of security. I would have thought that you could build a new oil refinery with a stroke of a pen. Easy. I can't imagine that comment ever being made in the US. We can't build a new oil refinery because it's not realistic. So I'm just left shaking my head. And I was reminded of that famous quote, if you think you can't, then you're right. So I'm a little pessimistic on the Australian economy from what I see in terms of the community attitude to fixing these problems. It's though getting the next cargo of diesel has solved our problems. I hope that is not the case. Let's have a quick look at the ASX 200. We've been consolidating now really since February. So middle of February, we've been up and down around this inflection point, just around 8,600. But the outlook for fundamentally doesn't mean the value of stocks will do this, but fundamentally, the Australian economy certainly looks as though it's got some problems. Let's move to precious metals now. Gold fell 2.5% for the week to 47.08. In Australian dollars, that was down just a little bit, 6,600. Silver was down 6.3, which is exactly what you'd expect, to 75.68. But the long terms here look really, really good. 4,800 is a key breakout level for gold, 4,800, 4,900. So a move above that, I think, will unlock the forces to drive gold higher. The long term for silver still looks fundamentally powerful. It doesn't mean that the price will move up, but the fundamentals certainly line up in terms of supply and demand. And we're seeing some quite exceptional price forecasts by the end of 2026. So these are not price forecasts a couple of years in the future, but for silver to be quite a few multiples of where it is at the moment by the end of this year by some of the world's biggest investment banks. Now, that doesn't make them right, but there's certainly massive statements being made by those investment banks. Now, if we turn to gold stocks, GDX listed in Australia was down 4.6% for the week, but the overall precious metals sector, I've been bullish on this for some time. There is substantial wealth to be accessed here, but it won't necessarily be straightforward or easy. It will certainly tax investors' psychology because the volatility I expect will be pretty significant. This was going to happen anyway, but the situation with the Iran war has just amplified the risks and the volatility here. And you've got to bear in mind that the market can do irrational, unwarranted things in the short term. And gold certainly cops enough of that because it's easy to sell. People may not want to sell their gold, but they have no choice. It's a degree of forced selling. So there is several different ways that you can access this substantial wealth into the future, and I'm talking the next 5 to 10 years. You can buy gold producers, and they offer a leverage effect of somewhere between 2 to 1 and 4 to 1. So if the gold price was to move 10%, then producers are more likely to move somewhere between 20 and 40%. So that's the leverage effect of having a reasonably fixed cost base. And the higher gold price just feeds straight through to the bottom line. So that's one way to do it. Now in Australia, we've got the issue at the moment of how much will the impact of diesel supply and cost impact the miners. Now, from what I've seen so far, and it's, we're only a couple of months into this very new scenario, is that the impact on Australian gold producers has not been very great. And their outlook statements are really saying two things. They're not expecting a disaster, but they are leaving the door open for a degree of unexpected eventuality. Let's just put it that way. So the door is definitely being left open by Australian producers that the cost impact and the availability impact on production is not really much of an issue, but they're saying it could be. So that's one choice that you've got, and there is a degree of risk in the long term. The second way is to access the more advanced development projects that, as they tick off the milestones to do with resources, to do with funding, to do with permitting, that the project gets de-risked and therefore the price heads higher. And to me, that's the way that I like to exploit the opportunity, because I don't need the gold price to move higher. The de-risking of the project will move the share price without having to see the gold price go higher. And then the third way to do it is to say, well, I really don't want that much exposure to those risks at all. So gold and silver royalty companies, as I've been saying over the last 4 weeks or so, removes the operational risks at any time, whether we've got a Middle East war going on or not. So they're the general ways. And then, of course, you can go into owning the physical metal in all sorts of different ways. Let's go and look at the charts on gold and silver. So we'll start first of all with silver. This is on a daily basis. You can see we're just really consolidating this meteoric move that occurred and ended up at the end of January. So naturally, we were going to get multi-months of consolidation after such a move. So this is just normal behavior. And if I look at the fundamentals, then to me, it just makes perfect sense that this is a consolidation phase and the next move will be to the upside. That's certainly what the fundamentals would dictate. If we look at gold on a daily basis, again, the same sort of thing. The volatility has been less, obviously, than silver. It's managed to hold above this initial low point, which technically was spot on. We came down and we found the support here. We had an intraday move on the 23rd of March that broke that, but it very quickly came back up again. the next move should be to the upside for gold. And in Australian dollars, obviously much lower impact because the Australian dollar is moving with this at the same time. Now, if we look at the stock indices themselves, which don't have a lot of meaning to me unless you're doing a fair amount of ETF buying. But there's GDX on a weekly chart. So this is the Australian listed version. And we've had a fair amount of volatility, but it's been a little quieter than I would have expected given the overhang of the diesel situation. And this is GDXJ, which is the US listed version, covering a lot of the still major gold producers around the world. So that's where we sit with those charts. The two key things that I'm looking for is what happens to the US dollar? Does it break below 96? And what happens with gold? Does it break above 4,800? They're the key points. Turning to other commodities, copper eased a little bit. It was 605 last week. We're just a tick down, but it's been fairly volatile. And crude oil fell into the mid to low 80s, but bounced back pretty hard to 95. And it occurs to me that very, very few people have any understanding of the essential role of hydrocarbons in our daily lives. And I did a video a couple of weeks ago that explored, to a very minor degree, but the role of hydrocarbons and what industries are exposed and what industries aren't. And I don't think anyone really has an understanding of what it is that goes into making our everyday life work. I think a lot of people are going to be very surprised if this situation in the Middle East gets worse. The problem with the Middle East is that there is so much uncertainty, but I think the thing that we can say with a fair degree of certainty is the longer it goes, the more severe the impact on the world, and particularly on Australia. So I think that is a statement you can make with a fair amount of confidence. There's the spot copper chart, just eased a little bit. And there's crude oil. It's been pretty volatile. It's been from 114 down to 83. So that's a lot of volatility in just a couple of weeks. So the final message, wrapping things up, this is the way that I think about the situation and the markets. This is the way that I would recommend everybody thinks about the market. First question, is this a sector or a stock that is reasonably immune from worst case scenarios and supported by the megatrends? Now, for me, there are two main worst case scenarios. One is around energy cost, energy security. The second one is around AI disruption. To what degree will AI disrupt the business model of a whole range of different companies? And again, we really have no idea how much and what is the time frame in which it will occur. It's as difficult to figure out as is resolution to the Middle East war. But there are stocks that are largely immune from these worst case scenarios. I've been talking about this now for 3 weeks at least. And there are more than enough of these. If you think you're limiting yourself just to have stocks that are immune, then there are more than enough for any investor, probably 5 times more than any investor could possibly need to buy. So why not just go there? Why not just take all this uncertainty out of play? Second question, is the stock that you're looking at the best of the best? Now, this requires a fair amount of detailed research, but it can be done. It is being done. And the Insiders Club members are getting the benefits of that. So is it one of the best of the best? Does it tick all the boxes in terms of management quality, business moat, return on equity? All those sorts of things are really important indicators of how well the company will do in the future. Next, question 3, does it have strong upward momentum? Because it's very easy to find a whole bunch of stocks that tick all the fundamental boxes, but the price is going sideways or maybe even going down a bit. So does it have strong upward momentum? There are some wonderful US software stocks that fundamentally are hugely appealing and will probably do reasonably well. But at the moment, the market hates them. And the prices are going down strongly. So don't try and pick a bottom in those kind of situations just because the fundamentals line up, because you might be setting yourself up for a fair amount of pain. So does it have strong upward momentum? Then the next question is, has it gone through some short-term profit taking? Have we just pulled back, which de-risks the entry opportunity? And this is all basic stuff, but if you don't have a thinking hierarchy, it's easy just to jump to the final point, which is this a low? Can I buy this stock really cheaply without having gone through the first ones? Because there's no point in buying a stock really cheaply if it hasn't ticked all the boxes before it. It doesn't guarantee you anything. So has it pulled back in price? And does the chart pattern, does the money flow provide a higher probability that we've seen a low point? So we're looking to buy a low point in an established uptrend. It's as good a formula as I know at a big picture level. So that's it for this week. Some food for thought. There's my email address. There's more information on the website. And I'll be back with you next Sunday. Cheers.